Hi, it's John Kelly. In this module, we are going to discuss some practical issues related to materiality and particularly what happens next year. And as always, we want to be efficient and effective, follow professional standards, and document what we have done properly. Now, to give away the punchline in all of this, I've said this before, but it's always going to be best to correct all errors, which means that you don't have to consider them next year, which can be very important. It means the statements are more accurate, and among other things, you don't have to advise those charged with governance, and this will solve or lessen many of the issues that we're about to discuss. Now, when we're thinking about what happens next year with materiality, we have to remember that almost always last year's errors will affect next year. If something wasn't recorded last year and income is too high, it will get recorded next year and income will be too low. So we always pretty much have to consider last year's errors as we assess the effect of this year and of materiality this year. Now, because the errors repeat, and if we have dismissed them as being immaterial, we really have to hope that all of last year's errors repeat again, because if they don't, we could run into a problem. And we have to hope that they repeat in the same direction and the same amount. And so let's just think about the ordering of errors, for instance. What I'm trying to say in the first line here is if we have a series of errors, all of which have the same effect, the same direction of effect on income, and we conclude that they are not material, if one of them misses out next year, we're hopefully okay because now the amount of error is smaller, though the amount of error reversing is larger. So we do get some level of impact on this year's income. So hopefully if one of them goes away, we're still okay. More of a problem, and I just have one plus and one minus, but you could have a series of errors in one direction that then compensate for a series of errors in another direction. And so, for instance, let's make something up. We have purchase discounts that are not recorded, and that's something that should have been deducted from payables. And we have interest that's not accrued, and that should have been added to payables. So let's assume they're the same amount, for instance, then the income effect is zero, because we should increase an expense and decrease an expense, and the effect on accounts payable is zero because it's a plus and minus. Though we do have to think about interest expense is too low, and cost of goods sold is too high. So we'd have to pause and think about it for a minute. Is that going to be something that affects users? And I guess it would depend on the size of the plus and the minus. And if it's the same as last year and it repeats every year, the impact is on payables and retained earnings, though again, if the two were pretty much the same, the impact on accounts payable and retained earnings is going to be approximately zero because it reverses each year and comes back. The problem that can occur here is what happens if these are two reasonably large numbers and suddenly the debt gets paid off, so there is no interest that's not accrued. And how do we fix that? We suddenly potentially have a material error appear this year that really the only way we can fix it is to go back and post an adjustment to last year, which is just all too obvious and disgusting and unnice. So that's why I conclude that it's always best to fix everything so we don't have this problem. The other big problem can be what happens if materiality gets lower next year. And that may reveal a material error, particularly if we have errors carrying forward from the prior year. And small errors that do not repeat may cause a material misstatement this year. So that's another problem with materiality, particularly when it drops year over year. And so let's have an example. Performance materiality last year was 100,000, and this year performance materiality is 80,000. And the principle is that if no errors were detected, we kind of have to assume that last year there were $100,000 of errors, and this year there are $80,000 worth of errors. And that means that we've got a potentially material error carrying forward because we didn't audit last year hard enough. We only audited last year to 100,000, and to be sure that there's no carry forward errors, we really needed to audit it to 80,000. So what do? I don't think there are really any good solutions. Perhaps we might drop performance materiality from 80 to 60. That might do it. The other thing we might do is watch closely this year for hints of last year undetected errors coming through in this year's audit. And then, of course, we have the unhappy solution of having to post a prior period adjustment to fix an error in last year's numbers. And to really exaggerate the example, if performance materiality last year was 100,000 and we had a $20,000 uncorrected error and concluded that that was not material, and suddenly our client gets a lot smaller this year, and this is exaggerated, of course. I don't know that this would happen. Well, it could. If you have a client that's selling off assets and they suddenly get a lot smaller than they were before, and this year materiality is $20,000 or $10,000, well, we've got a material error carried forward from last year. And we have two problems, because we have the known error from last year being material this, and what if there were another $80,000 of undetected error last year? What do? And how do we compensate for that? And again, I don't know that there's a really good solution to that. That an error we knew of last year was not fixed and is retroactively fixed this year, that's a difficult explanation. At least the client had to sign off that all known errors last year were immaterial, so we can also point to the client, but I think we're going to be pointed to as well. So there are a few good solutions. The first one, which I mentioned at the very beginning, is always fix all errors. Second one, which is sort of a solution, is to drop this year's materiality by the amount of change from the year. And then the third thing is to look for errors from last year in this year's audit. And those three things, if we document them, may solve our problem. And of course, document, 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 document. Particularly provide your explanations and rationale for what you have done. So, thanks for listening.